they are going to stop out. If the market will turn back up halfway through the summer, they have already stopped out. And so the fund is not going to enjoy the rise that follows. That's just one of the consequences of how we have it set up, and we don't know how else to manage it given the spirit of the Smiths and the prudent role that the active students have since they're gone. So one thing that they're going to do as they leave is position it in a very prudent way with some risk management to not exactly mimic the bench, but to be safe. And if the market continues going higher, they will enjoy that. But if it plunges, like it has done during the first half of several summers, they've got to have some risk management in it.
Josh, from a fixed income perspective, one of the things that is a little striking to me is how your active management period aligned with sort of probably a little bit of an evolution of the market's view around monetary policy. And so I was curious as to how your view and outlook on interest rates changed from when you took over active management up through when active management ended, and how that impacted your thinking around positioning that portion of the portfolio.
Yeah, we started out the active management period a little bit wary, getting into it, expecting sometime during the active management period that there would be an increase in interest rates. So expecting that, we got into some high dividend, but kind of a lower duration than our benchmark would be. As time progressed, it became clear that interest rates weren't doing this big shift to an upward interest rate movement that we were kind of looking for. Up until we came to the February lows of the 30-year. I think that was a Monday. Last meet's on a Tuesday. So Monday, the 30-year bond hits a record new low yield. A couple of other supporting things that come out. There's been some good economic indicators prior to that. The Mexico government released an article saying they were going to try to reduce their borrowing costs through 2015 in expectation of higher yields. So all of these things came together. That Tuesday we met, we increased our cash position, we got into TBF, we sold Treasury short, worked out terrifically up through the March jobs report where the 10-year went up to 2.25. That's where we kind of fumbled a little bit and dropped the ball. We should have gotten out there, we should have gotten out. That was a high for the 10-year thus far this year. We kept our view that interest rates were going to be rising at some point. I was anticipating that the Fed meeting following that March report, being that Yellen is so big on jobs, that they were going to take a more increasing rate sooner rather than later. They did lose some language, but they also adjusted their outlook for the rest of 2015. So, it's really been an up in the air kind of thing. Because of the short time period of the fund, I've tried to find areas where rates are going to rise for a short period of time. Over the long term, it doesn't really matter because we're not investing for the long term. So it becomes a little bit difficult there, that balancing act.
Okay, and with that, I just want to thank you all again for taking time out of your busy schedule and encouraging us, supporting what we do in the Osprey Financial Group and Common Culture Business at UNF, and hope to see you next year.
Good to meet you.
Oh, yeah.
It was fun. What's up?
Congratulations.
Thank you. Thank you for coming.